Okay, hello and welcome. My name's Anthony, I'm a director here at Amplify Trading. I've been joined by our head of trading, Piers Curran, who's going to be talking us through a bit of an outlook for 2018. So I've got a list of some questions we're going to go through. By all means, please contribute, add some questions into the chat room. We can address those afterwards as we go. So here we are. Feel free to address your questions to us. We'll pick them up after we've gone through. I've got 3 or 4 here. I'm going to focus on mainly the key events and get Piers' insight as to what he's looking for, and hopefully he can share some charts and so on and so forth. So, question 1. I mean, this is being quite specific when there's a lot of events going on, but what do you think is going to be the dominant theme for markets? Say Trump was 2017. What is it in 2018?
I'd say, well, obviously 2017, we've had some pretty key things happening. Certainly when you're thinking about Trump, certainly when you're thinking about just the political situation generally. Obviously, here in the UK, that's been particularly uncertain. Theresa May, I guess she's just happy she's got to the end of 2017 and she's still Prime Minister. She's had a roller coaster, to say the absolute least, but this has brought a lot of uncertainties. Obviously, Trump's finishing the year on what he thinks is the crest of a wave with regards to his tax bill. So I think as we go into 2018, I think the key word, the key thing for 2018 for global growth, therefore for let's say monetary policy, and therefore in the end for financial markets, is inflation. This is my key word for 2018. So what do I mean by that? Well, let me show you a chart of, hang on a second, what I'm going to do, let me just hang on, how do I do this? I'm just going to scroll this down. I'm just going to show you let's start with the US in terms of inflation. Let me just get the chart for US inflation here on the screen, because it's been a pretty, in the end, quite a surprisingly uncertain year on inflation. I think economists and traders and investors have been waiting for inflation to properly return for actually a number of years, and people were thinking that the start of 2017 was really the beginning of finally inflation rising back up to kind of normal levels, and indeed pushing up through 2%. As you can see here, in February we hit 2.7%. This was thought to be, the real starting point of wage growth and inflation, and this would shape the way for monetary policy and so on. But what happened, we had an unexpected dip in the summer, and this has kind of caused this question mark. What I'd say about 2018 is, given the fact we've had a very, very strong year for growth in perhaps the 2 most important areas in the world when it comes to thinking about global growth, the US and Europe are the biggest 2 economic regions, and both of those regions have delivered strong growth momentum. And in the case of Europe, finally, for the first time in a decade. The question is, does this feed through to wage growth? So are companies who are now delivering on, in many cases, record ever revenues and profits, as of yet we have not seen this translate into the average worker's salary rising at a rate that's normal looking back on historic terms. At the moment we've got wage growth running at about 2%, and if you look back before the crisis, you had wage growth of more like 4%. And so we've had a wageless recovery, a whole decade worth. And obviously this is spilling into the political situation, where you're getting disillusionment in the kind of lower income bracket, and it's led to Brexit, it's led to Trump getting elected and all the rest of it. But what we want to see in 2018 is this growth momentum strong enough to see companies start to properly deliver increases on salaries. And if that's the case, then incomes will rise, and this will allow consumers to consume more, which should therefore, if you look back at history, and I'm talking about economic cycles for the last century, then after a recession, when wage growth returns, this leads to an increase in consumption, which leads to inflation. Okay, it's just we haven't had that yet. So it's been the longest period ever of benign wage growth. So if wages go up and accelerate in 2018, then inflation will rise. Now this will shape everything from a financial market point of view, and indeed from an economic point of view, because I think the big risk for next year is inflation rises faster than expected, leading to people like the Federal Reserve to having to raise interest rates faster. At the moment, the Fed are guiding 3 rate hikes. If they need to do more than that, and if they need to do a lot more than that, then I think we've got a pretty interesting problem, because ultimately the debt crisis from 2008 to 2009, the debt hasn't gone away. It's just we've been able to afford it because borrowing costs have been at record lows. So if borrowing costs rise rapidly, which will happen if inflation rises rapidly, then maybe we're vulnerable to, you know, the debt affordability taking a turn for the worse, damaging consumption, and we get a recession. So we could worst case scenario next year, if inflation jumps sharply, we could have a consumer driven recession as a result of borrowing costs rising faster than people expected. That's a risk. Now, obviously, over the last few years, inflation hasn't risen fastly, and every year it's kind of disappointed. So, you know, is it going to be the case that this weird scenario continues? I would say there's much more risk of inflation rising next year than it did this year, and that's because the labour market slack has reduced even further. And so, again, just looking back at previous cycles, you know, this is the moment where wages start rising. And so that's something that Powell is going to have to deal with. Obviously, Yellen's handed over the baton on a timely manner here, just as she's kind of steered the ship pretty well, I would say, through her tenure. Actually, the hard work's about to start with the Fed's exit, I would say. So inflation certainly, and inflation, I'm talking in the US, but let's look at the UK chart, because the UK have got a slightly added problem with regards to the inflation situation, and that's our inflation is already too high and has been too high for pretty much the whole year. And Mark Carney's had to send a letter to the government for the last 3 months in a row now, trying to explain why they failed on their mandate, because their mandate is to keep inflation at 2%, and here it is at 3% and now higher. So this is a key problem in the UK, because wage growth is also very weak, and so wage growth is less than inflation, which is very negative for consumption in the medium to long term. So we've got a key issue here in the UK. That obviously the Bank of England hiked rates, and that was a big curveball for this year. I certainly wasn't expecting that after the Brexit vote in 2016. That was definitely not on my radar. I'd say that's probably one of the biggest surprises of the whole year for me, is the Bank of England raising rates. But there's one glimmer of hope, I would say, for Mark Carney on the inflation side, because actually, why is inflation so high in the UK? And let me just enlarge my cable chart here. And I want to look on a long-term weekly chart. This is the value of sterling against the dollar. And let me just go back so I can just see the Brexit vote. So the big reason for inflation being so high is that the pound's value dropped sharply. Okay. Now, obviously inflation, we tend to, these charts I'm showing you, that's an annualized inflation measure. So it's looking at prices of goods today compared to what they were 12 months ago. So when we say inflation's at 3.1%, then prices of goods have risen by 3.1% in the last 12 months. Now, a lot of this inflation problem is because of the pound's drop in value, and this leads to import prices going up. And because we import more than we export, this is a problem, and so inflation has risen. But check out the pound's value today. Okay, as we hit the end of 2017, we're trading around, let's just call it 133. Okay, well, yeah, let's just say 134. All right. Now, where were we 12 months ago? Well, actually, it was at the end of 2016 that we had this drop to what is still the current low since Brexit, and that's down at 1.2. So actually on an annualized basis now, the pound is now more expensive than it was 12 months ago. Sorry, it has a greater value. Now the thing about inflation, there's a lag, and so we're not seeing, let's just say for transitory reasons, I would expect the inflation situation in the UK to start trending lower as we get into Q1 of 2018, because on an annualized basis the pound now is going to be more expensive. So I hope this is what Mark Carney's crossing his fingers for, and that's on his Christmas list, is a calming of inflation, because I don't think the Bank of England want to raise rates next year. I don't think they will either. That's certainly a debate going on, but I don't think you'll get another rate hike from the Bank of England next year. And I think the currency's level on an annualized basis is a key part of that.
Let's just one hypothetical then on the back of that. Let's say Britain securing a transitional deal is the baseline scenario.
Yeah.
Then should that mean then that the current pricing of 2 rate hikes by 2020 is about as dovish as it gets? Because by securing the transitional deal, the curve will need to move to facilitate that actually we are at the most bearish it can be on the outlook, but once let's say logic would say that the deal is going to get done.
Yeah. So yeah, with the Brexit thing, I mean, that's definitely, obviously we've had a positive development coming into the end of this year with sufficient progress being made on the divorce settlement, enabling them to now start negotiating the trade agreement. But of course before then, as you say, the transitional deal will be the next step. So that's where the UK government are looking to negotiate a 2, if not 3-year extension, a transitional period beyond March 2019 to buy time to actually implement what will be an incredibly difficult exit from a logistical point of view. Just all the stuff, I don't know, one of 100 different things. One example would be on the border control situation. Just in things like in Dover, for example, right now there's 2.5 million trucks that go through that port each year, and at the moment less than 1% of them get checked. Now that's because we are in the customs union and everything's fully aligned, but if we're not anymore, well, how is that dealt with? And you're going to need a hell of a lot more than 1% getting checked. And I mean, there's some analysis that's been going around, whether it's 100% valid or not, I don't know, but one analysis computed that if the amount of checking goes up by just, or I think it was if the time spent checking goes up by more than 2 minutes per truck, then you're going to get a 17-mile queue on the M20 with the backlog. So I don't know, it's just logistical things like that are going to take a huge amount of time. The other really important thing on the transitional deal is this, so they need that deal apparently by March 2018.
Yep.
Okay, and this is because then businesses want reassurance that there's going to be a transitionary period on exit, because at the moment, if you're an owner of a business, and if we get to less than 12 months from exit, okay, so that'll be the end of March 2018, will be 12 months away, and if there's still a risk that, this idea no deal's better than a bad deal scenario, so if we're 12 months away from what could be a clean break hard Brexit, well then businesses start to, they're going to need to start planning for that 12 months in advance. So they need assurance that we are going to leave, and we're going to leave on terms that are going to be favourable, and that we're going to leave on terms that has a transition period to implement, and all of these things to give them confidence to actually start investing. Because at the moment I think a lot of businesses are saying, look, we're going to have to hold back here. GDP growth in the UK is on the way down, exacerbated by the inflation problem, and if you don't get businesses start committing to investing and spending soon, then we're going to have a recession. So this is the government's issue. They need to secure this transition deal by the end of 2018. What you got to then realise is, though, that the rest of 2018 will be spent on the trade agreement. That's the hardest part of all. And so, whilst hurdles have been jumped over here, the biggest one's still to come. And so, definitely you're going to get a roller coaster 2018 for Brexit. like you have for 2017. It's like any negotiation. You heard what Theresa May's been saying in the last week or so. It's now the sufficient progress has been made, right, let's talk about trade, and by the way, EU, we want everything. You know, we want all our cake and we want to eat it all. And that's because that's how you start a negotiation. You start out saying, well, I want X, Y, Z. And the other side say, well, you can't have any of those. And then you know, messy process, find your way into the middle ground. So there's definitely going to be ups and downs.
So if you were making a year strategy, then you're looking at almost like road humps in a calendar year of end of Q1.
Yeah.
Well, I guess what you're saying then, really, that's absolutely critical at that point.
Yeah.
So if you're forecasting or planning longer term, you've really got to factor that in as probably one of the most biggest
a pivotal
uncertainties.
moment. Yeah. I'd say that by the end of March 2018, Theresa May needs to have delivered in writing, signed off a transition deal of at least 2 years.
Okay, on the spot then, if you had to give a percentage probability of that happening by March 31st,
yeah,
what are you going to go with?
90%. I think it has to happen.
And the 10%,
on both sides want it.
And then what's the
10% would come from actually an implosion of the Conservative Party and the Theresa May leadership before then, delaying progress on the negotiation, which is not likely, but you know, she's got such a slender majority with the DUP that you only need a few by-elections that go the wrong way, and all of a sudden you've got an interesting problem. So that would be right, but I don't think that'll happen. I think they'll get the transition deal.
Okay. So next, not kind of traditional markets, but something which, of course, that you and I have to talk about because it's what the public demands in 2017. Obviously, actually, if you looked at 2017, I guess, if we had this conversation at the end of 2016, it wouldn't have even really got even a look in. We're trading, sub 1,000 quite easily at that point. But obviously, Q4, we've had this almost like was it 11 month between 1 to 10,000, and then within a matter of weeks, it doubled.
Yeah,
which is
Bitcoin mania.
Bitcoin mania. So, what's your take on not just Bitcoin, I guess, but cryptocurrencies, and is this the beginning of the next big thing, or are we not at that point yet? What's your kind of your feel for that at this point?
I don't think cryptocurrencies are the beginning of the next big thing. No way. I think it's still in the. I still think it's a bit of a fad. I think blockchain's definitely the future. That's the real sort of technological, success story. I think Bitcoin and cryptocurrencies are. I just think there's no. My big problem with it is the concepts around it and the way it's done. I don't see why that's the future or can be the future. I mean, I think at the moment it's trading as a speculative commodity only, and the problem with it is that it's incredibly hard to value fundamentally, if not impossible to value fundamentally. And so that's the reason why I am skeptical of it. If you can't value something fundamentally, how do you judge? Is 20,000 too much? Is it too expensive? Are we in a bubble? Is 20,000 too cheap? Or is it about the right price? I mean, no one really knows. So it's all driven by, a lot of it's of course media driven. Frenzy is the right word, and I would say there's a very high likelihood that we're in a bubble. Now obviously that's irrationally driven, and trying to judge and predict when irrationality is going to end and the bubble bursts is almost impossible. I think if you sell the top of Bitcoin, if it is a bubble and it crashes and you've sold the top, then it's pure luck. I think it's absolutely pure luck. You just can't predict irrationality. I've got a good slide here. Someone sent me this. We're going to just show you a picture. Someone sent me this morning. It's inevitable this that gets talked about. I mean, I went to a lunch yesterday, and of course, question pretty much number. I was there for literally about 5 minutes, and already Bitcoin was being discussed. And the guy I was talking to sent me this. It's actually, just to say, bubbles are not new. This is actually a chart of the South Sea Company share price. This is in the 1700s, as you can see. And this is where it spiked from about £100 up to pretty much £1,000, and then collapsed all the way back down to less than £100. And this is, you might have heard of this chap, Sir Isaac Newton. Genius, except that he bought here at the bottom. So Newton invests a little bit, and he's nice and happy, he makes a profit. Well done. Then he exits. But then his mate didn't exit, and his mate's getting rich, and so Newton's like, damn it, it's like the fear of missing out, FOMO, right, I've got to get back in. But what he does is he re-enters with a huge position. To start with, it's looking amazing, and then of course the bubble bursts and he collapses back down. You can see where he exits, and he lost his entire fortune. And his great quote here: I can calculate the motion of heavenly bodies, but not the madness of people. So that's what I mean by, trying to predict irrationality where you can't. So I don't know. Who knows? I literally don't know if Bitcoin, it could hit 40,000 by the end of January. I've absolutely no idea. Or it could be below 1. So I think it's behavioral driven. I think it's technically and behavioral driven entirely. So there's too much. I'd say from a trading point of view, there is no more risky trade out there at this moment.
Yep. Okay, so
I'm still skeptical.
Yep. Okay.
I might be proved wrong. But
final thing then, just to wrap it up. There's obviously Trump, as we said at the very beginning, was the focal point really of 2017, and as you rightly said, he's managed to get the first big bill over the line just in time for Christmas.
Yeah.
What happens to Trump next? Where does he go?
So I think so Paul Ryan made, so he's the leader of the House, so chief Republican, if you like. He made a quote earlier in the week, and he said this tax deal will lead to middle-income families being $2,500 better off next year. Now, I think he made a suicidal mistake with that quote, because the problem with Trump's tax plan is that, yes, it's the biggest in history, but it's almost all of it, this $1.5 trillion tax cut, almost all of it is on the corporate side. So it's a tax cut for corporate America. Now, this is where the uncertainty lies, because what do companies do with this extra money that they would have paid on tax? What do they do with it? Now, if they use it and say, right, let's pay our staff more money, let's increase wages, well
which there was some news today.
Yeah.
AT&T said, Merry Christmas is $1,000.
Yep.
And I think Boeing, some other companies,
right.
Comcast.
So this is
short term, obviously.
Right. If that's a one-off bonus,
yep.
then fine. Obviously, that will give a nice kick to consumption, but that'll be one-off. We're not in the business of one-offs. We need sustained wage growth. So whilst that's a PR stunt.
That's a classic Trump.
That is a PR stunt. That's all. And so if this tax cut leads to wage growth, meaningful wage growth, then fine. All right, middle America will benefit. But I've got some serious doubts about that. I think corporate America will more than likely do what they've done for the last few years, which is increase share buybacks, maybe increase dividends, for example. More likely that than invest more in business growth and increase worker salaries. And so I think actually the critical thing for 2018 in America is the midterm elections, which are in November. And I think if this tax deal doesn't lead to an improvement of the everyday life of the average Joe in America, then I think that will be the final nail in the coffin for this idea that Trump is delivering on his election mandate. And Trump got elected because he was going to improve people's lives. And I think that if they don't, and I actually don't think they will, so I think the midterm elections are going to be a bit of a disaster for the Republicans, and they'll lose their majority definitely in the Senate. And so I think actually from Trump's point of view, this tax deal may well be, and it's a significant deal for sure. I think it will be, and it's his first success in Congress. I actually think it might be his last, because he'll lose his majority, and he won't be able to do anything else for the rest of his term. So that said, but the other thing to say is that, look, other than that, the US economy is on fire. Momentum is just off the scale, and so we'll certainly get a positive. That'll spill into 2018 for sure. So, US growth momentum at the start of 2018 is going to be strong, and we're going to just need to see if inflation kicks up as a result of that or not. And I guess the other thing is in Europe. Don't forget Europe here in terms of their back to the table, contributing to growth globally. How quickly are the ECB going to scale back QE? You had Weidmann, this week starting to talk about the need to end QE and starting to think about raising rates. These things need to be considered when it comes to asset prices. And I think perhaps the asset class that I would be most mindful of next year is actually not equities necessarily, which is at an all-time high. As you can see, it's been a record-breaking year for the S&P. 13 months in a row of positive monthly gains, record ever in the 90-year history of the index. So fine, all right, that's vulnerable, maybe up there, people questioning whether this rally can continue, and I think it won't. I mean, I think Q1 will be the peak, but I don't necessarily think equities are the risk. I actually think it's bond markets, and I think that this comes back to what I said at the beginning. It's inflation. Does inflation rise faster than expected? If so, this is the chart of the US 10-year government bond, and when this moves lower, yields rise, and if inflation rises faster than thought, yields are going to have to rise from where they are now, which is still record lows. And if you get a key break of that, a break of that 2013, 2014 double bottom, which is also that low in 2016, these two red circles here, key technical support. If you get a break of that, then you're starting to look at perhaps a reversal signal on what has been a 30-year bond market rally. And I think that technical event could well lead to a huge amount of selling with no liquidity on the buy side, and so you could get a bit of a bond market event. A big spike in volatility on the downside, and that's yields rising, which in itself is actually a tightening factor on the underlying economic system. So I think bond markets are the asset to watch with regards to the inflation uncertainty. So that's what I'm looking at.
So I just wonder whether then that this, you kind of, a play would be equities then, if this occurs, slower, or the response would be sharp and fast from the Federal Reserve. This all gets halted in terms of the plans going forward. So then equities is kind of a Goldilocks scenario again of, can they I guess, all right. But then if inflation rises faster, then you don't have a choice.
The Fed, they're going to have to make a move and hike. And so actually that Goldilocks thing's, I think in America, the Goldilocks story's done in that, it used to be bad news is good news, because bad news and the Fed will stimulate more. But actually, they're not stimulating now. They're tightening. And all right, it might slow that tightening cycle, but not if inflation is the thing that is the problem. Then it will be the worst of both worlds for equities, because you're getting inflation being too high, damaging consumption, and the Fed have got a hike anyway to try and control it. Borrowing costs go up, double whammy. So I think equities and bonds will have a down year in 2018. There you go. Said it. Said it.
So that is against all 9 major banks on Wall Street.
Yep.
Who are looking for 28.50. But that's right. You heard it here first.
That's right. Well, JP Morgan in the summer of this year
This
called
is
the
true.
top in the S&P.
Yeah.
And it's done nothing but rally for the next 6 months. So, you know, these banks, they're big institutions, but they don't necessarily always make good calls. But who knows? I mean, that's just my humble opinion. I mean, I could well be wrong, but I think you will. Don't get me wrong. I'm not shorting the S&P now. That's not what I'm saying.
Yep.
I'm saying that you'll probably get a bit more upside in quarter one, but I would look for the top in the US equity rally. I would look for the top in quarter one at some point, and then I think you'll get sideways to downwards for the rest of the year.
Any comment on, just because people were talking about it this morning,
Yeah,
which was just the last thing, and then we'll finish up, about the
FANGs.
kind of outperformance of the FANGs, these tech names, and then obviously there's a little bit of, well, there's not a little bit, there's a lot of Trump involvement within this in terms of the different sectors and implications on the tax side, as well as regulation, which is obviously on his agenda for 2018.
Yeah, I think a lot of this has been pricing in the tax deal, but that's now done, right? So, you know, the buy the rumor, sell the fact scenario, and I think you look at some of these. This is in percentage, right? Is it?
Yep,
Percentage
so.
return on the year. It's just quite extraordinary. These aren't startups. These are the biggest companies in the world, and you're getting 50+% upside in a 12-month period. And all right, I get the fact that growth is really strong in America, and I get the fact that global growth has actually started to improve this year. But come on, I mean that.
This is market cap, I think this is looking at.
Okay, market cap, yeah.
But still.
But still, you get the point. So I think this rally, I think, is pretty much done. And certainly tech stocks will lead that. If I'm right, and I might not be, but if I am right, profit taking in the tech stock sector will be a big part of that theme of US equities peaking in quarter one and sideways to downwards for the rest of the year. So don't buy tech stocks now. I think you've missed it. But don't short the S&P now. That's not what I'm saying. But I think the end of this rally is near.
All right. Well, let's thank you very much, Piers, for your time and your insight.
Pleasure.
We'll revisit this again, same time next year, and then we'll see.
And we'll discuss how I was spectacularly wrong.
Yeah. So when I'm on my yacht with my Bitcoin millions, we can I can invite you around for a tea. But okay, thank you very much, everyone, for listening. I did see there was a couple of questions, so we'll just finish the actual recording of the session, and then we'll address that question from Christy. All right. Thank you.